Tensions in the Middle East escalate as U.S. officials downplay the risks, leading to a significant rise in stock markets. Additionally, major companies like Pfizer are making headlines with strong earnings reports. Here are today's top 10 stories you need to know. In a significant development, U.S. officials have downplayed escalating tensions in the Middle East, particularly between the U.S. and Iran. Following Iranian strikes on an oil terminal in the United Arab Emirates and vessels in the Strait of Hormuz, concerns about a potential war have intensified. However, U.S. statements suggest that diplomatic efforts may be underway to avoid further escalation. The implications of these tensions are profound, affecting not only geopolitical stability but also global oil prices. As the situation develops, the U.S. is expected to maintain a close watch on Iranian activities, balancing military readiness with diplomatic engagements. Analysts predict that any shifts in this dynamic could have far-reaching effects on international relations and the energy market. Observers are keen to see how these tensions will influence U.S. foreign policy moving forward, particularly with upcoming diplomatic talks planned. Pfizer has reported first-quarter earnings that surpassed Wall Street's expectations, reaffirming its outlook for 2026. The pharmaceutical giant announced revenue of $14.45 billion, driven by the growth of newer products, particularly following its $10 billion acquisition of the obesity biotech firm Metsera. This acquisition is part of Pfizer's strategy to diversify its portfolio as sales from older COVID-related products decline. Analysts are optimistic about the company's growth trajectory, especially as it continues to invest in innovative therapies. The positive earnings report reflects Pfizer's resilience and adaptability in a rapidly changing pharmaceutical landscape. With the healthcare sector under scrutiny, Pfizer's performance may set a precedent for other companies in the industry. Moving forward, investors will be closely monitoring how Pfizer leverages its acquisitions to drive future growth. Hecla Mining has reported substantial year-over-year earnings growth, significantly impacting its investment narrative. The company's recent earnings surge is attributed to strong quarterly revenue expansion, supported by a favorable outlook for gold prices amid geopolitical tensions and U.S. debt concerns. Analysts have upgraded Hecla's rating, noting that it meets critical growth stock criteria. This positive shift is essential for the company as it navigates the complexities of a rapidly evolving market. The mining sector has been under pressure, but Hecla's performance could signal a turnaround for similar entities. Investors are now looking at how Hecla can sustain this momentum moving forward, particularly in light of ongoing regulatory challenges and market volatility. As the global demand for precious metals continues, Hecla's strategic positioning in the market will be crucial for its long-term success. In an impressive showing, U.S. stock markets have reached new record highs, buoyed by optimism surrounding economic recovery. The S&P 500 and Nasdaq have both seen significant gains attributed to a surge in technology stocks, particularly Intel, which soared 13% following news of potential partnerships with major companies. This surge follows a broader trend where tech stocks have been leading the market rebound, reflecting the sector's resilience amid global uncertainties. The Dow Jones Industrial Average also experienced an increase, reflecting broader confidence in the market. Analysts suggest that the positive momentum is indicative of a recovering economy as investors respond favorably to strong earnings reports and encouraging economic indicators, such as decreasing unemployment rates. Furthermore, the dip in oil prices has alleviated some inflation concerns, allowing markets to thrive. As investors look ahead, the focus will shift to upcoming economic data and Federal Reserve announcements, which could significantly influence market movements and sentiment in the coming weeks. The Federal Reserve is facing dissent among its officials regarding interest rate policies, reflecting deep concerns over inflation. Recent discussions revealed a growing consensus among some members for a more aggressive approach to interest rates, driven by persistent inflationary pressures exacerbated by geopolitical tensions, particularly in Iran. Historically, the Fed has balanced the dual mandate of promoting maximum employment while ensuring price stability, but the current environment is testing this delicate equilibrium. Some officials argue that the risks of keeping rates low may now outweigh the potential benefits, especially as inflation continues to erode purchasing power. This division among Fed officials signals a critical turning point in monetary policy, with implications for the broader economy. Market analysts are closely monitoring these developments, as any shifts in Fed policy could affect everything from mortgage rates to stock market stability. As inflationary pressures mount, the Fed's forthcoming decisions will be pivotal in shaping the economic landscape over the next several months. Oil prices are experiencing notable fluctuations as geopolitical tensions in the Middle East escalate, significantly impacting the global market. Recent Iranian strikes have heightened fears of potential supply disruptions, prompting traders to react with increased volatility in oil prices. Historical context reveals that the region has long been a critical hub for oil production, making any instability a cause for concern among investors. Meanwhile, U.S. officials are downplaying these tensions, fostering a sense of cautious optimism in some segments of the market. Analysts argue that if diplomatic efforts can successfully mitigate these conflicts, oil prices may stabilize, easing anxieties about a looming supply crisis. The energy sector is particularly sensitive to these developments, with countries reevaluating their oil import and export strategies. As the situation remains fluid, the next few weeks will be pivotal in determining the trajectory of oil prices. Investors will be keenly focused on diplomatic negotiations, as a resolution could restore balance to the market and enhance overall economic stability. U.S. stock markets are experiencing a significant recovery as investors respond positively to encouraging economic data released this week. Key indicators, including GDP growth and employment figures, have shown signs of resilience, fostering renewed confidence among traders and analysts alike. This optimistic sentiment has led to increased activity on trading floors, with major indexes such as the S&P 500 and Nasdaq posting notable gains. Analysts attribute this rebound to a combination of factors, including robust corporate earnings, particularly within the technology sector, which has historically driven market performance. As businesses adapt to evolving market conditions, there is a growing sense of optimism about sustained economic growth amidst ongoing challenges. The financial markets are now closely monitoring upcoming economic reports, including inflation data and consumer spending trends, which could significantly influence investor sentiment and future market trajectories. This recovery phase is critical for the economy as it navigates persistent inflationary pressures and global uncertainties. Investors are particularly focused on maintaining this momentum, as it will be vital for achieving long-term economic stability and growth. Geopolitical tensions are significantly impacting global markets, particularly following the Iranian strikes in the Middle East. These incidents have raised serious concerns about security in oil shipping routes, particularly through the Strait of Hormuz, a vital corridor for global oil transport. As a result, fluctuations in oil prices have emerged, causing broader market volatility. Investors are reacting cautiously, aware that any escalation in conflict could disrupt global supply chains, leading to inflationary pressures and economic instability. The situation has prompted discussions among policymakers about the potential need for intervention or support to stabilize the markets and mitigate the risks posed by rising energy costs. Analysts are closely monitoring developments, recognizing that the ramifications of these tensions extend far beyond the immediate region and may affect international trade dynamics. The current landscape has created uncertainty among businesses and consumers alike, impacting spending and investment decisions. In the coming days, market reactions will likely hinge on diplomatic efforts and any announcements from key stakeholders involved. How this situation unfolds will be critical for both investors and policymakers as they formulate strategies to navigate these turbulent waters effectively. Inflation concerns are dominating discussions among economists and policymakers, particularly in light of recent geopolitical events. The Federal Reserve's recent meeting revealed a divide among officials regarding how to address rising inflation rates, which are partly attributed to tensions in the Middle East. These tensions have disrupted supply chains exacerbating existing inflationary pressures that have lingered since the pandemic. Some officials argue for a proactive approach to interest rates to curb inflation, while others caution against making hasty decisions that could stifle economic growth and employment recovery. This debate underscores the complexities of managing economic policy in a volatile environment where external factors can significantly impact domestic conditions. Market analysts are watching closely, as any shifts in the Fed's approach could have significant implications for both domestic and international markets. Higher interest rates might cool inflation, but could also lead to slower growth, affecting consumer spending and business investments. As the situation evolves, the Federal Reserve is expected to release further statements clarifying its stance on inflation and interest rates. This will be crucial for setting market expectations and guiding investor sentiment. Looking ahead, the Fed's decisions in the coming months will be pivotal in shaping the economic landscape and determining the trajectory of inflation. In a remarkable turn of events, U.S. stock markets have surged, largely fueled by optimism surrounding economic recovery and strong corporate earnings. The S&P 500 and Nasdaq reached new all-time highs, driven by a notable rise in technology stocks, particularly Intel, which saw a staggering 13% increase following reports of potential partnerships with major tech firms. This surge is significant, as it reflects a broader trend of investor confidence in the economic rebound, especially after a challenging period marked by inflationary pressures and supply chain disruptions. Key indicators, such as consumer spending and employment rates, are showing signs of improvement, further bolstering this sentiment. The Dow Jones Industrial Average also saw significant gains, signaling a collective market response to positive earnings and economic data. Analysts suggest that the combination of strong earnings reports and optimistic economic forecasts will continue to prop up stock prices in the near term. This market resilience amid geopolitical uncertainties, including tensions in Eastern Europe and trade issues, speaks volumes about investor sentiment. As we look ahead, attention will be focused on upcoming economic reports, including GDP growth figures and inflation data, which may further shape market trajectories. Investors are particularly keen on how these factors will influence the Federal Reserve's monetary policy decisions in the coming months. Thank you for joining us today. Which of these stories shocked you the most? Don't forget to like and subscribe for more updates.